Hi everyone, welcome to another of our virtual event broadcasts for ILS NYC 2021. Please visit the event website to view the details of our kind sponsors, without who we couldn't put on this event. As with all of our broadcasts around this event, we're looking at the development of the insurance-linked securities market, always with one eye to the future, and this year focusing on defining the next generation of the sector. For this broadcast, I'm delighted to be joined by three partners from global law firm Mayer Brown: Steve Rooney, Ricky Spitzer and Colin Scagell, all of who work on numerous ILS transactions and structures and are very well known in the space, I would say. Thank you for joining me today, gentlemen. So
Thanks, Steve. Thank you for having us.
Great to see you all. So we're going to discuss the important role of legal structuring within the ILS market, as well as how that may evolve over the coming years and how ILS structures can promote innovation in the marketplace as well. And I would just say that the legal work in the ILS world is significant. It's really what helps people to innovate. The ensuring that everything is buttoned up in the way sponsors and investors really need it to be is critical. So it's great to have Mayer Brown with us today. So I'm going to start with Steve Rooney. Perhaps to begin, you could give us just a bit of background on where you see the ILS market from your vantage point at this stage in its maturity.
Sure, Steve. And thanks again for having us. And in Colin and Ricky and myself, you have the core of Mayer Brown's global practice, advising clients on the convergence of insurance risk in the capital markets. So we're really pleased to be with you. I think it's interesting you ask about the maturity of this market. It is there are a couple of easy reference points to measure its maturity. One obviously is it's been around for 20 plus years. So we're certainly in young adulthood here as this market goes. And in those first 20 years, I think there was a relatively slow start to the amount of bonds outstanding. If we think about ILS market initially as the property cat market, and in those years, it stayed relatively modest. I think after 2007, 2008, ironically, right around the time of the financial crisis, some major insurance company sponsors came to market, and it seemed to be more of an accepted tool, risk management tool. So today, it's remarkable to think about $30 billion of property cat bonds being outstanding, and 2020, obviously, as you've reported, being a record year in terms of volume of issuance. That's certainly a sign of maturity. There were 36 sponsors that came to market last year in 46 transactions. And I think another sign of maturity is that many of those sponsors, some of them were new, which is a sign of maturity of a market, but also many of them were renewing expiring bonds. And so we've now are at a point in the maturation of this market that regular sponsors have been using programs now over and over, and they're into the third, fourth, fifth generation. In the case of USAA, maybe their 12th generation of bond issuances. So that's certainly a sign of maturity. The last point I'll mention is that I think the market's been tested. Hurricanes went silent there for a time in the recent past, but then reemerged. And even before they went silent in storms like Katrina, there were bonds outstanding that involved loss payments. And there've been very few legal challenges to the mechanics of the bond structures and how they work. And to our knowledge, none of those legal challenges have been successful. So the structures have evolved in a way that they work, they've been tested, and that's a sign, I think, of maturity, because new sponsors considering coming to market, will ask the question, how do I know, am I taking on risk? Is this going to work as well as my traditional reinsurers will work? And the answer, I think, is it may work a little differently, but the object is met, and the deals work. All of those are, I think, signs of maturity.
Yeah, it's interesting that you mentioned USAA, because I think when we covered their last deal, we found it was their 34th individual issuance under the residential re program, which is a very impressive track record. And I suppose one of the things that enables people to keep coming back is the way the market evolves to improve the coverage, and the number of options in the market also evolves as well. And Ricky, turning to you, I wanted to ask sort of how important the evolution and expansion in the number of domiciles is, do you feel, in offering sort of a broader range of options to sponsors in the space?
I think for the market generally, having optionality is good, because the only way you're going to have change and evolution is if there are opportunities to do things different ways. If you keep doing the same thing, every deal the same way, it's very easy to just do what was done before, because that requires the least amount of effort and work. But sometimes, even though it can be more work to move to a new jurisdiction, to do something a different way, you may discover in that process, well, actually, this was a better way to do this, or this is actually adding an opportunity for this type of a transaction that maybe wasn't there before. The market has evolved even with respect to jurisdictions anyway. When the market really started out, I'd say most, if not all, of the vehicles were established in the Cayman Islands. Then obviously Bermuda put in place its special purpose insurer regime. And I think in many ways, whether it be through the nature of the service providers, some of the changes in the legislation that Bermuda put in place, people decided that maybe the Bermuda vehicles offered some opportunities that the Cayman ones did not. So a lot of the market then shifted to Bermuda, because certain European entities have some, either it be regulatory or tax issues with ceding risk to Bermuda. Ireland kind of was there as an option for those people. And that's an example where if that wasn't there, maybe some of these European sponsors just couldn't do deals because of some of the issues about going to Bermuda. Going more recent, now you have Singapore, which has its regime. The regime they have actually has been in place, I believe, for over 10 years, but was really not utilized or otherwise. And the government obviously put the grant scheme in place and really took some strong efforts to build up an expertise in Singapore. And now you've had a number of deals done in Singapore. There are some others that will happen this year that will be done out of Singapore. And it's become a legitimate center for ILS issuance in Asia now. And then Hong Kong is in the process of, it's actually put out draft rules. It's put the legislation in place. It's working on its own special purpose insurer legislation. It's really initially, at least, going to target risks coming out of China. That's its sort of initial target audience. And that will be a sort of type of risk, a type of sponsor that we've not seen in the ILS market to date, at least not in any sort of significant way. And that's, again, that's evolution. That's bringing different types of sponsors, different type of risks into the market. And so I think having this optionality is good for the market as it evolves.
Yeah, absolutely. And I think getting risks coming out of China through a dedicated hub could be quite exciting for the market as a whole, because it's not the easiest place to originate from. Right. Colin, moving on to you, perhaps you could sort of say a few words about the expansion and optionality in Europe as well, because now obviously we have a UK domicile and also the first official ILS structure at Lloyd's as well. Do you think that's going to help to stimulate more activity as well?
Yeah, sure. And as Ricky says, we come at it from the perspective of more choice is good for the industry, rather than this being perceived as competitive in nature. It's about being complementary. And as Ricky says, and the same is true in the UK, there are certain sponsors for a whole variety of reasons that drive, a particular market or, a new jurisdiction to open. Lloyd's is the obvious one, vis-a-vis the UK regime. In its early days in determining whether that's going to be successful or not, I still think it's early days more broadly across the whole, UK regime. It certainly has benefited certain sponsors. But I think that, you know, when people are choosing jurisdictions, they're looking at a whole range of factors, including timing, costs, efficiencies, and in some cases, it just makes sense. So as Ricky's alluded to, some cedent jurisdictions, you know, favor the domicile of the SPV being either the same or in a complementary space. Sometimes it's because it's the type of the market. So for example, you know, very few people think of Gibraltar, but it has its own ILS regime, and it made perfect sense for the deals that we were involved in, transferring lottery and gambling risk, because Gibraltar is the home of lottery and gambling risk. So, you know, the regulator there knew the business really well, and it happened to be very closely connected with the, you know, existing legislation being in place, but actually understanding the risk. And in the same way, you know, we've seen interaction with Lloyd's and the PRA in the UK. So again, you know, there's a whole range of factors that go in. One thing we've seen is that if you're a new sponsor, also dealing with a new jurisdiction and a new set of rules, that's just invariably going to take longer, and it's going to require upfront investment of time, legal fees, and education. So we still feel that, you know, to Steve's original point, the market is maturing nicely, but there's still a lot of education that needs to go on, and people shouldn't be afraid of that. They should, you know, embrace it.
Yeah, it actually came up in one of my discussions previously at this event around sort of onshoring versus offshoring as well, and how onshore structures, particularly in the US, could actually really stimulate another phase of growth for this marketplace as well. That optionality seems to be key.
Yeah, I think that would require some tax law changes to bring at least the property cat market onshore.
Yeah, no, I think you're right. I think people are looking at sort of broader range of risks really for that type of thing, and maybe even around the annuities and life space where large investors are looking for ways to get involved who maybe don't want to go offshore so readily. While I've got sort of three legal experts on the line, I thought it'd be interesting to bring up a conversation that used to be a perennial at every ILS market conference. The topic of documentation and standardization and simplification, and that's sort of it's a subject that was, as I say, very, very widely discussed and then went a little bit quiet in time. But do you think it's worth resurrecting this discussion as we think about how the ILS market finds a new wave of growth? And I'll direct that to you, Steve.
Yeah, Steve, interesting. I mean, I think our take on that question about standardization of documents is, you know, on the one hand, it's been happening. It's been happening without maybe a lot of discussion. It is something that in the context of executing a deal or setting up a new program for a sponsor, there are always discussions around how do we do this more efficiently? How can we facilitate the use of this new program in the future, not just for the first deal we're doing, but for the year after that and going forward. And so I think that there has been an effort to standardize documents and continues. It's a continuum. When you think about, you know, I saw Mike Millet's video a few days ago, and he mentioned the first deal 25 years ago or so, Georgetown Re. It took a year to do that deal. The legal fees were in the millions of dollars. Today, you know, you can get these transactions put together, you know, in a matter of weeks. And the legal fees, I can tell you, are, you know, a fraction of what they used to be. So there has been standardization. There are documents that today, you know, we don't, the working group does not spend a lot of time renegotiating. And so I think it's happening, and it's happened and it continues to happen. That's one point. Another is one of the, you know, we talk about innovation in this market and making the product more useful for sponsors as well as more attractive to investors. And the result is an evolution of market terms that are beneficial to those parties, to the parties involved. And some of those innovations, just don't write themselves, if you will. Mm-hmm. It requires, some intense drafting and oftentimes analysis to make sure they work when they're first introduced. And so, this happens to us, the three of us talk about it all the time in the context of deals as we get started. Is this going to look like, the prior deals or the marketplace? Are there innovations being suggested? Whether it's the broker underwriter or the sponsor looking for some innovation, we have to think that through and draft it. I don't think that's a bad thing. And if you standardize documentation too much, you're going to stifle that kind of innovation. So I think there's a balance, and I believe that we as lawyers and participants in this market, as well as the brokers and underwriters who arrange these deals, I think have worked together in a collaborative and efficient way to achieve that kind of efficiency. I'm not sure it helps, in the abstract to talk about standardized documentation. It does make sense to talk about it in the context of, individual projects. And I believe it's happening. Ricky and Colin will have a comment to make here, I'm sure.
Well, Ricky, I'll ask you for yours then.
Yeah, no, I agree with what Steve said, and I emphasize, one of the very first conversations that we have internally on every single deal is, okay, this is what they've described. What are we going to start with? Because there have been a lot of deals in this marketplace, and while there are differences among the deals, a lot of this stuff has been done before. So when we hear the deal structure, we think about, okay, so it's got a little bit of this, a little bit of that. What do we start with? Because again, we don't want to start from scratch. That's not useful to anyone. It's useful to present this as, okay, this is an evolution of what was done before. This is similar to this mechanic that was already thought through before. And that's I feel like that's almost one of the important conversations we have on every deal is, what are we going to start with? Because if you start in the right place, you're kind of already a step ahead then as you kind of evolve the documents, you draft the documents and prepare things. And I do think that is an aspect of standardization, but it still allows for the flexibility of the innovation, which is continuing to happen.
Yeah, and that flexibility is obviously really key as well. And it's demonstrated repeatedly by sponsors who like to tweak their coverage just to try and get it closer to their traditional protection as well. Colin, have you got a view on that? And do you foresee any structural innovation coming along that the market can maybe capitalize on?
Yeah, I think that the market, as we said at the very beginning, as it both matures, it's also responded almost on an annual basis with new things, new features that have been, either investor driven or sponsor driven. We've touched on domiciles, and I think it all part of a complete picture of choice, and also, the ability to attract the capital and make the great leap to risk, and that sort of perfect marriage, which is what the whole convergence, industry or part of the industry is about. So, we see multi-platform approaches becoming more prevalent now. So, the ability of some of the seasoned sponsors to really take advantage of having in their stable, a series of cat bonds, for example, some sidecars, some funds, that idea that we're moving towards more permanent capital, as it were, and finding, vehicles, the most efficient vehicles and structures in which to warehouse that money and to put it to work, and to make sure, as Ricky says, one of the great advantages of our practice and the nature of it being global is that we are able to call each other and say, well, I've seen 80% of this before. this is an extra 20% that's different. How can we take something from over here? Because that's what our clients want to know. They want to know, how much is this going to cost, and will you make it efficient? Oh, and by the way, can you tell me it works? So, you know, over the last few years, we've seen a proliferation of a little bit of this, a little bit of that. Can we give an English law opinion on this? Is it more suitable to give the New York style of documents? Can we use English law? What's going to happen in Singapore and Hong Kong? So, you know, as Steve and Ricky have both said, we see this as an evolution, a constant evolution, and a real positive that the market has never stood still. You know, year on year, you know, just by way of example, last couple of years, the BMA come out with this collateralized re, that sort of, you know, is meant to be for a more market-facing type, you know, vehicle. You've not just got the domiciles that are coming on stream that suit more sponsors, but you've got things like Guernsey last year, where it said, okay, we'll do a one-stop shop. We'll do a transformer and a fund in one. You know, it doesn't mean that there's going to be 25 transactions in the first 6 months of these things. And I personally think the same will be the case of Lloyd's most recent, you know, pronouncements about wanting to, you know, utilize ILS structures. Instant success shouldn't be, you know, sort of sought. I think it's as an evolution, and people's rush to sort of have, you know, 20-25 transactions using a particular domicile or structure is kind of missing the point. What is more typical is we see transactions with a little bit of this and a little bit of that. And even just, for example, you know, the Sussex protected cell cat bond just a couple of months ago from Brit, you know, that was a first, but it also listed in Bermuda. You know, there are many ways where this can be complementary, and you can have sort of English form, US investors, all that, and that's good. That's, you know, that's to be applauded from the wider market.
Yeah, and it gives them, the ILS market, a sort of wider tapestry of available options for sponsors, and it's really important that the market has been responding to people's needs as well. And I think you make a good point, Colin, about the rush to get transactions, when actually it's more about being there, educating the marketplace, educating the investors, and then finding ways to encourage them to put your structure to work in their capital management, I suppose. Steve, moving back to you, perhaps you could say a few words about sort of new sponsors. I mean, obviously we've seen a few in the last year, some particularly interesting ones. Do you think we're going to see more of those? Do you think encouraging new sponsors to market is a big opportunity for ILS right now?
I do, and we have seen you know, some interesting new sponsors come to market in the past year, but you know, really goes back to right after Superstorm Sandy, when the MTA had a problem in renewing its coverage in the marketplace, and capacity was constrained and pricing was untenable for them, and we worked with them to come up with a solution to do essentially a storm surge cat bond deal. That kind of motivation, if you will I think continue as we have further cat events, earthquakes, cybers may be the next frontier, other types of perils that non-insurer entities are exposed to, and the traditional markets, you know, perhaps haven't been able to either offer a product or offer capacity or an interest, or there's some other dislocation. There may, you know, there are opportunities, I think, that will arise for the ILS market through innovation to solve that problem for that non-insurer client. But it's interesting, you know, the California utilities sponsoring deals for wildfire, healthcare companies, tech companies addressing the market. These are, I think, these are trends that I think will continue. There are challenges in doing so, because I think the original product that we're all familiar with, insurers and reinsurers sponsoring deals, involve a lot of basic insurance concepts. And so, for example, the tax lawyers know how to analyze the flow of payments and issues like withholding tax and other tax issues. When it comes to non-insurers doing it, a whole set of new questions arise. And so it's interesting to think those through. I do think we'll see more non-insurer sponsors taking advantage of the ILS markets here. I also think we're likely to see more and more insurers think about accessing it. And there obviously is a long list. If there were 36 sponsors in 2020, that's a rather wide net of companies taking advantage of this market. But there are some well-known companies that have not taken advantage of it. And I think as they see the $30 billion market develop, and obviously something like pricing in the traditional market, could impact, and capacity issues could very well impact those companies' motivations to come to the market. As I was saying before, the general maturation of the market, the confidence that people have that the deals work, when there's loss events, they get paid efficiently. I think will have people, more sponsors think about accessing the market.
Mm. And as we've been saying, all of the the evolution in options available is really helping to make it more suitable to different types of sponsors as well. Ricky, moving to you on the sort of risks and perils side, I guess it's the other side of the conversation. Is around, do we get new sponsors, or do we offer sponsors even more ways to transfer more types of risks? And still in the cat bond market, it's largely a property catastrophe space, and really across other ILS structures as well. But do you think that's going to change? Are we going to find ways to see longer tailed risks ceded, for example?
Yeah, I think you will, and I think it's already started to happen. I mean, even in the cat bond market, I haven't looked at the most recent statistics, but I believe mortgage insurance is about 10% of the outstanding bonds at this point. That's a risk that a few years ago really wasn't there, definitely not in this kind of size that you see now. So that's sort of a different type of risk that's become an important part of the cat bond market. You've seen deals covering terrorism, third-party motor liability, even some of the California wildfire deals actually cover third-party liability for wildfire. So you've seen a little bit of that. I think the cat bond market, because of the way the deals are structured and the intent to have liquidity relatively short term, it lends itself well to sort of low frequency, kind of high risk type events. But if you broaden out to sort of insurance linked securities more broadly and start thinking about sidecars and collateralized reinsurance, you actually have had deals, and I realize there's not as much transparency about that market. Some stuff is not necessarily as well publicized, but there have been deals that are starting to cover longer tail risk, casualty, in different types of structures. I think there are some funds as well that are starting to pick up those type of liabilities and starting to look a little bit more like traditional reinsurers, at least in the type of risk that they're covering. So I think if it may be that certain products are better suited for different types of risks, but the sort of broad ILS technology, I think, works for lots of different insurance risks. And it's really a matter of, how long are people willing to come in and invest for? Obviously, certain lines like casualty, it's going to be a longer tail type business. So you need to figure out either investors are going to stay there longer, or you need to figure out how you're going to deal with the tail at the end of the deal. But I think that's already starting to occur. And I think it probably will continue.
Yeah, it does seem that we're moving away from a market that's always preoccupied by short tail and becoming a little more open to a bit of correlation as well in places too, as with the mortgage deals. while there isn't always a great deal of crossover in the investors, the structure and the methods of securing capital market reinsurance really remain the same. Ricky mentioned the sidecar structure there. Colin, perhaps have you got any thoughts there about what that side of the market will do over the coming years? I mean, it's been a slightly more challenged place in terms of loss creep really hit some of the sidecars in quite a bad way over recent years, but they seem to be coming back to the market quite significantly at the moment, especially on the private side.
Yeah, and as Ricky alluded to, you know, there's a fair degree of uniform structure around a cat bond. So if we go back to how we talked about when deals come in, what we find with the sidecar market is that in itself, ILS is already a broad church, and sidecar as a part of that is also a very broad church, because for some people it can mean something more like collateralized re. Is it market facing? If we go back a few years, sidecars tended to be what we'd say event driven. So they were like capacity supplements, a true original traditional sidecar. But then, you know, a side-by-side syndicate at Lloyd's is just another sidecar. So structurally, it's very different in terms of the documentation that's put alongside. But, you know, a follow-on syndicate, a follow-only syndicate, a tech-driven syndicate, they're just a form of sidecar. I say just, there's a lot to it. So I think that there's more opportunity to have, you know, a differentiated approach in the sidecar or the collateralized re-market, although those deals don't always hit the headlines in the way that the cat bonds do, for obvious reasons. They've got a wider investor base, they've got much better liquidity, there's a lot more familiarity with the structures. We see more breadth of types of sidecar deals than we probably do in the more traditional cat bond space, if we can say that. And just, you know, what are investors and sponsors looking to do? We see, because when you have back-to-back difficult years, as you've alluded to, and then you have more held back collaterals we have had in the last few years, you then have the kind of conversations that come to the fore are around expense allocations, where that capital or holdback should be set relative to the traditional market. How is that going to respond? And these kind of repeat sidecar deals, those are the conversations that are coming to the surface in a way that we would not normally have seen had we not had high incidence of loss in consecutive years. It's almost like these deals, they've proven to work, I should add, but, you know, again, it's an education process for investors. It wasn't that investors ran away, far from it. They just needed to understand, you know, how these things played out in practice, you know, and you know, again, to Steve's very first point, the sign of a mature market is where, with the right education, everyone understands, and Ricky may have mentioned this, you know, information flow is critical in terms of, you know, investors appreciating how this money gets put to work, particularly the investors that are not necessarily the ones that are very sophisticated in this market. You know, there's a true benefit to them not just reading documents that lawyers prepare, but actually understanding in practice what this means. Do I want more information than every month or every quarter? Just because one deal is quarterly and the next deal is monthly doesn't make one right and one wrong. It's just got to fit to, and I think personally on some of the sidecar developments, they're more interesting because they give you a little bit more of a free range to actually sit down with a blank bit of paper, and we get involved in the term sheet stage. And Ricky, Steve, and I will frequently look at something and go, I'm not really sure this is quite what people have in mind. So let's almost take a few pieces away and build it up again. So whilst I don't think that they get the headline attention, and some of them are very much private deals for obvious reasons, there's a lot of flexibility in what you can do in those structures. And that's a good thing.
Yeah, no, absolutely. That's a very good thing. And I think one of the things I've noticed over the last couple of years is the way sidecars are being used as sort of just ways to bring in new capital is going to be more permanent and sit alongside somebody's balance sheet and support them on the peak risks, which just makes perfect sense.
Yeah, and people are doing that. You know, they're putting funds on top of sidecars and then having multiple platform sidecars underneath. You know, that's a market development. And it's closely allied to these big private equity houses, you know, the gorillas in the room, like the Apollos and the KKRs. They're approaching this market, or, you know, the broader insurance market, in a completely different way, to just deploying, when I say just, deploying capital to one risk on an internal quota share, for example. That's still relevant and perfectly, you know, fits into people's strategies. But the really interesting thing is taking it to the next level and incorporating, you know, a multi-strategy fund on top of a number of sidecars with a number of cedents in a big group with a number of underwriting platforms. That's where this is going. And the clever bit is making sure that while you're fiddling with something over here, you don't forget how it fits in holistically to what the client's trying to achieve.
Yeah, no, that's really interesting, and obviously speaks to making use of the capital markets for efficiency as well, which has always been the goal. Moving back to you, Steve, as a law firm, what's Mayer Brown's priorities in terms of trying to help promote ongoing innovation in the ILS market and ILS market expansion over the next few years?
Yeah, to be careful, you know, as a law firm, we're not promoters in the same way as other participants in the market are, or even yourself. But I think our role here is, as has been discussed, is really first and foremost an educational role. And I think we can, and we have, spent a lot of time with regulators, whether it's regulators in Hong Kong or Singapore or the UK or in Bermuda, even as their concerns evolve, and in the US with certain US regulators. We can be educators. We can explain the purpose behind different structural features. Some of the structures, as in many structured finance deals, are a bit off-putting to the uninitiated. And I think to help explain to people the purpose behind some of the features and how they're consistent with regulatory goals is one role we can certainly play. I mean, as a law firm and as a firm that has a global insurance industry practice, because we do transactions in other parts of the capital markets and in M&A markets, we deal with regulators frequently, and we have a regulatory team. And I think this is, you know, we definitely see that as part of our role, and we think that will help promote the market. The other educational role is with sponsors and would-be sponsors. There are lots of clients that we're otherwise doing work with, some of the capital markets work, and this is how we originally got into this market to begin with. These same treasurers and CFOs and risk managers said, well, what about accessing risk capital in the capital markets? And for some, and some very sophisticated clients, they are cautious about the idea that they would do a securities offering, you know, or sponsor a securities offering, you know, that implies imposition of, you know, securities regulation and the possibility of a new group of investors being disgruntled at some point in the future if they lose money. And gee, aren't I exposing myself to undue risk? Why don't I just access the traditional market where I'm used to, you know, how those things work out? And I think that we definitely play a role there in helping those clients understand the realities of it. And yes, there are risks and there are rewards to be had, and there are risks that can be mitigated. And I think that, you know, we see our role very much as doing that. But there's lots of ideas too. I mean, one of the fun things about this market is that people are innovating all the time. People meaning our clients at the brokers and the bank underwriters, as well as sponsors. And you know, gee, how do we solve for this problem? What happens if there's zero interest rates here? You know, these are collateralized deals. How do we deal with that? How can I apply this peril, you know, or fit this peril into a capital markets instrument? And you know, there are lots of fun issues, and a lot of the time we spend analyzing things don't necessarily lead to, at least to date, new transactions. But it's that kind of testing of the waters and testing we lawyers on issues, legal issues and structuring issues that ultimately do lead to innovation. You know, one of the areas that I think it's curious, I've been reading more and more about cryptocurrencies and their prevalence, and I see, you know, Tesla announces that they have $1.5 billion of Bitcoin in their treasury now, and other companies, MicroStrategy, even MassMutual is holding cryptocurrency. Why? Because every central bank in the world is printing money, and even the dollar, its value is directly or indirectly being debased, and that's a concern. I wouldn't be surprised, you know, if maybe we see cryptocurrency as a form of collateral in these deals. That'll be interesting if that happens. But the other perils that you know, the climate change related perils that are emerging, wildfire is an example of something that, you know, we worked on. It came to market just 2 years ago now. So those kinds of innovations, I do think, you know, cyber risk is something that is here to stay, if you will, and has become a greater and greater concern of risk managers. Wouldn't be surprised if we see, you know, some movement there in the ILS markets. So there's a lot going on, and you know, we're excited to be part of those discussions and facilitating both sponsors and arrangers and working through the issues necessary to bring new kinds of deals to the market.
Great, thank you, Steve. And I guess the educational side that you laid out there is really key in helping new sponsors to understand what they're getting into and to giving them comfort in going through a securitization for the first time. But on the other side of that, Ricky, perhaps I could turn to you. When we think about defining the next generation of ILS, we also need to sort of borrow from what's been done well elsewhere in financial services and the capital markets. And do you spend time at Mayer Brown thinking about how structures can be made more efficient, perhaps be borrowed from other areas of the capital markets and applied to insurance risk transfer?
Sure, every waking hour. No, but we do. And again, so I'd say two things on that. One, mortgage insurance is a good example of borrowing. Obviously, mortgage-backed securities, it's a massive market. The mortgage insurance deals, they're still ILS, but aspects of those deals are absolutely borrowed from mortgage-backed securities. That makes sense considering the nature of what those deals are. I think the other thing, and Colin mentioned this earlier, we went through a really long period of time where there really weren't any loss events, and then you had a number in a relatively short period of time. All of the deals worked. The ILS market performed as you would expect it to do. But you know, we all learn from our experiences, and from having now gone through a loss reporting process for some of these companies, you know, we realized that there are aspects of these processes, while they all work, maybe they didn't work quite as intended, maybe they weren't as efficient as intended, maybe there were too many levels of review that were duplicative and really weren't adding any robustness to the system, just for adding additional pieces of paper that needed to be passed. And so we focus on that. We think about that. Okay, it worked, but maybe there's a better way to have done that, or that process wasn't quite what people thought it was going to be. Let's adjust that going forward. And so structural changes, not big changes, but minor changes were made following those deals because we learned. And again, I think that's an example of evolution. I think it's an example of the maturity of the market, realizing that once you go through these processes, there are ways to make things better. That's one of the things I think everyone's trying to focus on. You want the structure to be robust. You want to make sure that sponsors are getting what they're purchasing, but also that investors are protected, that they understand the risks, that they understand that there are processes in place to protect their interests. And then if there are processes that actually aren't providing any value, well, let's get rid of those. That doesn't make sense. That's not actually helping anyone. That's just adding complexity. And so I do think we learned from that, and deals are influenced by that.
Yeah, no, obviously that's really important when it comes to, again, new people coming to the market, that the learnings from more challenging times can be applied to make things a bit more predictable going forwards as well.
Right.
And
I also think, towards the point, just quickly on
sure,
bringing new sponsors in. I mean, one of the things that you heard from some people for a number of years are, well, but if I do one of these deals and I'm a sponsor and the event occurs, I'm never going to get paid. So why would I sponsor a cat bond? And I think what we've seen is that is not true. When the event occurs, these deals pay. And in fact, sometimes they may actually pay quicker than traditional reinsurance. So again, that should be an encouragement to people. This is a space, if you're looking for risk capital, this is a good place for it.
Yeah, absolutely. That's a good message. And obviously the credit quality is very strong as well with fully collateralized, which should be
absolutely
positive for any sponsor. So Colin, perhaps we'll finish up with you and ask you to get your crystal ball out, and from your vantage point, what do you think the next year or so brings for the ILS market?
Well, as we all have said, and more than most, Steve, 2020 was an extremely record year on cat bonds. 2021 has been a strong start. Q1 looks pretty healthy, both in terms of announced deals and what's in the pipe. So certainly very positive for the year ahead. One thing that COVID has definitely impacted is interest rates are not climbing back to whatever people think are normal levels anytime soon. COVID has effectively pushed that out. So, that was always one of the attraction points, if you will, for the growth of the market, as Steve alluded to back in financial crisis times, global financial crisis times of 7, 8, and 9. Investors, there's no shortage of capital seeking, something better than nothing. So there's still the so-called wall of money out there, and I think that that's only going to grow so long as central banks are pumping money into the system like we've never ever seen before. And so as an asset class or as an area, for the same reasons as it was attractive 10 or 12 years ago, it's probably even more attractive. And I think that there's no coincidence that huge pension fund type investors are now seriously looking at the idea of applying or committing some kind of permanent capital to this area, for sure. So, the future is bright.
Yeah, and I think that permanent capital has plenty of places to be put to work from the comments you've all made today. So thank you all, gentlemen. Really appreciate you agreeing to do this. Thank you, Steve. Thank you, Ricky. Thank you, Colin. And thank you to Mayor Brown. So I look forward to hopefully seeing you in person next year rather than over Zoom.
Same here.